financial assets, if we look at the period 1981-82 to say 2020, during that period of time, both bonds and stocks returned superior returns. In other words, it was heaven for financial assets for almost 40 years. And I think this period of heavenly conditions for financial assets has come to an end at the end of 2021, January 2022. That's the peak of the stock market. And from here on, returns will be, for most people, disappointing.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, folks, here we find ourselves at a doorstep. Here with a brand new YouTube channel designed to educate and empower the regular investor to navigate what lies ahead, while at the same time, a very murky, very uncertain future is unfolding before us. And when the road ahead is hard to discern, it's wise to tap the counsel of those with a strong command of the lessons of history and the practical experience of a lifetime in the market trenches. There are few who fit that description better than Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. I can't imagine a better mind to kick off this new channel with. Colorful, brash, and brilliant, Marc understands the global economy through a historical lens practically unmatched in the industry. And he's a declarative straight shooter who doesn't mince words. Marc, thanks so much for being my first interview on Thoughtful Money.
It's a great honor. Thank you very much.
All right. Well, thanks. And look, as folks can see, new background, new studio. We're still getting a few things put into place, but we are sort of building the race car as we're driving it here. Thank you again for being the
congratulations
first person to see me. Well, look, Marc, I usually start these interviews at the high level, and then I kind of drill down into more granular topics. I think I want to flip the script this time with you because there are so many big macro topics right now that I want to get your insights on. So let's start with the macro, your macro outlook, your outlook for the economy, and your outlook for the markets. And then I want to get even higher than that if we've got time. So first off, why don't we start with this? We're talking here in November of 2023, a new year looms ahead. As you look out, what do you see in your forecast in terms of what the economy, how you expect the economy to perform next year globally?
Well, I think I have to clarify how I look at the economy. When I talk about the strong economy, it means that GDP per capita of the majority of people increases. And if I talk about a weakening economy, it is that the GDP per capita in real terms, that is inflation adjusted, diminishes. And you can observe this. You just have to talk to your friends or to people, or if you have a business like you have and I have, we pay out salaries and so forth. And we also have costs, and we can look at the cost increases every year, or in some cases, costs are coming down. But in general, we have as a businessman, you have a relatively good feel about what the cost of living increases are, and if they are actually cost of living decreases. Say, if in a country rents decline by 30%, a major burden on people's household income is relieved because they pay less rent. Then we have to obviously also analyze in that society how many people own the houses and how many people rent and so forth. So there are lots of variables in an economy, and we can have interest rate increases. If you have money and you have a lot of cash, it benefits you. On the other hand, if you have a lot of credit outstanding and credit card debts that are variable, it will hurt you. On the other hand, if you have a house with a fixed rate mortgage, it doesn't hurt you all that much, and so forth. But in general, what I observe among people, and I live in Asia, but the economies of Asia and Europe and the US are similar. But what I observe is that for most people, the cost of living have increased more than their salaries, and they are not as well off. Let's say they have less spending power than before. Now, statistically, the government can show that spending goes up, retail sales are going up, and so forth. But if most of it is price increases or inflation, as some people would contend, then the real gains are not very high. And secondly, if I look at macroeconomic indicators in the world, most countries report figures that would indicate essentially a stagnation in economic activity. And in some cases, you can visibly see that the incomes are going down. In other words, the standards of living are going down for most people. So the outlook is murky, it's not very favorable. Having said that, as an investor, I always look at opportunities. And it's interesting that in the worst economic situations, occasionally great opportunities arise. I mean, we have at the present time, strikingly, emerging markets having underperformed the US for many years, maybe 10 years since 2009. And as a result, emerging markets have become inexpensive compared to the US. Or you take in the US, you have a very high valuation of technology. On the other hand, material stocks, and especially energy and energy-related stocks, are relatively cheap. They're not absolutely cheap as they were in 2009 or 2003, but say compared to technology stocks, energy stocks are relatively low. And we had this huge debacle in the bond market where 30-year treasuries have tumbled now for 3 years in a row. They just started to rally. I think this rally may carry on for a while, but the low in interest rates we had in May, August 2020, I think these lows will stand. And from here on, we are in a rising inflation wave and in a rising interest rate structure. But it can extend over 20, 30 years, the way this inflation lasted essentially 40 years. So these are long-term trends, but they're interrupted by counter moves. So I could argue in 10 years' time, interest rates will be higher, but I could argue over the next 6 months, interest rates will come down. You understand? And it creates
Absolutely.
the volatility that we have in markets, which is relatively high.
All right. Great intro. There's lots and lots I want to dig into there. So let me just sort of take it in order then. So you talked about how it sort of depends who you are in the story in terms of how well you're faring, right? If you've got a fixed mortgage, you know, if you've got inflation adjusting income streams, you know, you're probably doing pretty well, right? Or at least you're not that worried. If you're kind of a regular person, you know, regular wage earner, feeling the full force of the increase in cost of living we've had over the past couple of years, you know, you're probably finding it harder and harder to hang on. I had Michael Kantrowitz on my previous program recently, and he talked about this bifurcation. He was sort of talking about it in the economy, which is sort of a milestone you see before you head into recession, is some parts of the economy remain doing well while others start to roll over. But I think you're talking to almost more of sort of a socioeconomic bifurcation here, which is that, and it's not news to anybody, but you know, the wealthier, the top 10% are continuing to do fine, and maybe even on a relative basis, their prospects are getting even better. But the vast majority of folks worldwide seem to be looking at diminished prospects from here. Am I capturing your outlook correctly here?
Yes, correct. And especially, I think as an investor who has a longer term horizon, let's say as a stock investor, you'd always think, well, are these stocks going to give me a decent return over the next 10 years compared to, say, cash, or compared to gold, or compared to real estate? I have to say, financial assets, if we look at the period 1981-82 to, say, 2020, during that period of time, both bonds and stocks returned superior returns. In other words, it was heaven for financial assets for almost 40 years. And I think this period of heavenly conditions for financial assets has come to an end at the end of 2021, January 2022. That's the peak of the stock market. And from here on, returns will be, for most people, disappointing. Not necessarily for me, because my return expectations are, say, around 4 or 5% per annum. But for people who are aiming at like 10, 12% returns, I think they will be disappointed. And if I look at the stock market, a few stocks have been very strong, the FANG and FANG-related stocks, but the typical stock hasn't done very much. And I run broad portfolios of stocks in Europe, in Asia, and in mining companies and so forth. For every stock that moves up, another one breaks down somewhere. So there's every day at least something to be positive about and something to be negative about. But well, the overall portfolios haven't done well.
Right. And of course, that's what makes a market, right? Is
yes.
You know, as an active investor, your goal is to try to have more of those wins than the losses. But, you know, listening to you, Marc, I'm kind of taking away, maybe I should restate what I said earlier, which is I'm getting the sense that you think maybe almost everybody's going to be kind of disappointed in the coming era, meaning it's not going to be as easy to have those, you know, heavenly financial returns in the big financial assets, which of course are concentrated in the hands of the top 10% of households anyways, right? So stocks go up, really doesn't benefit the average guy all that much, but it does benefit the top 10% who own, I think, what, 90% of the financial assets. So you're saying there's going to be headwinds on financial asset appreciation from here. And I think from what I'm taking from what you're saying about, you know, sluggish economic growth going forward, higher inflation, higher cost of capital in general, the general economy is not going to grow as much, and that's not good for the bottom 90% of folks. So, you know, I don't want to be too depressing here, but I mean, are we kind of looking at a rougher decade plus ahead than we've enjoyed?
Well, I think to answer your question, the best is to travel through an airport nowadays and compare it to traveling, say, pre-COVID or 10 years ago. Airports have become unpleasant experiences. There's no question about this.
And
there are delays at the airlines, and there are lost luggages, and a lot of different things are much worse than they used to be. And I think this is the kind of pattern we all have to get used to live with, that will earn less than we had expected. Things infrequently will cost more for lower quality, or we'll have to live with higher services costs and lower service providers. In other words, everything is becoming more inconvenient. Nothing is becoming more convenient. And you'll have also these conflicts in the world that may last for a long time and be costly. People don't realize you can finance the war in two ways. You can essentially, you should increase taxation, because If you told people a war will cost this and that much from your income, people wouldn't go to war. But because the government is used to lie, they will not do it through higher taxes. They'll have inflation. Inflation is a tax that comes up through deficits of the government. In other words, the government spends more than they collect in taxation, and then you get inflationary pushes, especially if you have friendly central banks that will finance the deficits.
Mm-hmm. You know, and on that point, so right now, the central banks have been more than friendly over the past 20 years in general.
Yes.
They've been practically lecherous. But right now they are showing a rare restraint, right? And because of inflation, right?
I'd like to interrupt here.
Sure.
You say they're showing restraint. This is correct in the sense that the cost of money through the rise in interest rates has gone up. Okay, that we can all agree.
Yep.
Where we need to be very careful is to determine whether money is tight or not. As you know, last week we had very, very significant bounces in stocks. I mean, some stocks bounced back by 10% in one day, like gold shares or stocks that were depressed, they jumped 10% over 3 days. Is money tight when this happens? I doubt. I think money is more expensive, but isn't tight yet. Normally, a sign of really tight money would be if spreads between high-yield bonds and treasuries explodes.
Right.
Has not happened yet. Hasn't happened. And volatility index has been in a low range. It increased until about a week ago, but then it also collapsed by 37% in just 3 days.
Well, so I want to have you comment on this then. So you know, I've talked recently about how right now most of the central banks are, you know, pressing their foot down on the economic brakes, right? They're raising the cost of capital, they're doing QT, but at the same time, especially here in the U.S., we have the fiscal side jamming on the accelerator with these sort of wartime deficits, you know, when we're not mobilized in a war, right? So we have this, you know, this conflict right now, which is, and all that monetary, fiscal stimulus is goosing, you know, it's getting out in the real economy here. So is that what's creating this scenario right here?
To a large extent, yes. If you analyze really GDP growth, and then you analyze the credit growth of the government in the US, you would find that the increase in government debt vastly exceeds the increase in GDP,
right?
Nominal terms.
Sorry to interrupt, but that just means it gets worse for us because the benefit of additional debt is diminishing and diminishing and diminishing, right?
Yes, correct. And number two, I have to say this about the fiscal deficit. Transfer payments, let's say if the government gives you money because you have a child or because the government thinks that you need a housing allowance and so forth, it's, I mean, an intervention into the economy, and it then enlarges the government at the expense of the private sector. Now, you and I, in our economic education, we have to believe something. Now, I admit there are people who believe in big government. They think the big government is good for economic growth. But my experience, having looked at economies that were previously ultra big government, the communist governments, the socialist government of Eastern Europe, all these economies were left behind compared to the free market economies of Western Europe and the US and Canada and Australia. So I have to believe that free markets and the capitalistic system are the best way to grow an economic system. I'm not saying the capitalistic system is ideal, but it is the best system we can have that combines growth and freedom. You understand? Under socialism and communism, in theory, you could have prosperity, but you have less freedom. Because the state will tell you what to do. The government has a monopoly over all assets. They own everything. You don't own anything. And they control the corporate world, and they say to you, you can work here or there. But you have no choice. It's the government that tells you to do things. Whereas in the capitalistic system, I admit that there are some slaves in the capitalistic system that are enslaved by excessive debt. So they have to wait for the check, the monthly paycheck, to pay their credit card debts, the interest on the credit cards. These people are somewhat enslaved. Mm-hmm. But most people in the capitalistic system, whatever their position is, it's a choice.
Right. And they have more potential, at least, to improve their station.
Yes, exactly. Now, I'm not saying everybody, because somebody in the capitalistic system could get sick or have an injury, then they have no choice anymore. But we have in the capitalistic system, we had already in the 19th century kind of associations that were helping the poor. Nowadays, we have social security and health insurance and so forth and so on. But in general, I would say if we can agree among us that free markets are preferable to the state monopolies, if we agree to that, then we have to also agree that small government is better than huge government. Huge meaning the communist planned economy, and entirely free markets would be the robber baron days of America in the 19th century, which were outstanding in terms of economic growth. They also created disparities, but they created a huge increase in per capita, real per capita GDP, because let's say people like Carnegie or Rockefeller and Vanderbilt, they lowered the cost of production, and through trains and refrigeration, you could ship meat from Abilene and then later on Chicago to the East Coast at lower and lower cost. Transportation costs fell in the 19th century. So it benefited actually everybody. And why did so many people move to America? Because wages in America were higher than in Europe. That is the reason.
All right, Marc. So remember when I talked about how I wanted to take this at a level and then move it higher? You're heading exactly in the direction that I wanted to. And just to show my hand here, I think we can make an argument, and I'd like to talk about it with you in a few minutes, that if you look at the trajectory of Western governments, it is looking like they are perhaps becoming less free market driven and less personal freedom driven versus more. And I want to get your thoughts on that. But before we get there, to summarize what you're saying, I'm going to paraphrase and murder the paraphrase. I believe it was Winston Churchill or someone like him who said, capitalism is the worst solution that we have, except it's better than all the other ones, right? It's the best of the worst, right? It's not perfect.
It's not perfect, but I mean, I recommend your viewers or listeners, it's not a difficult book to read. And if they find it difficult to read, they can listen to some lectures by Milton Friedman. The book is called Capitalism and Freedom. This is now really the kind of sort of Bible you should read to understand what government does. And the fact is simply, in the 19th century, by 1910, none of the industrialized countries of the West had a government that was spending more than 12% of GDP. Now it's around 50%. And as the government expands, growth shrinks.
Mm-hmm.
It's illogical. And as the government expands, freedom diminishes. I mean, I think people, I talk to a lot of people wherever they are, and they say, look, you live in Thailand, here you don't have any voting rights, but life is relatively free. When I go to Switzerland, I have to be careful. I don't drive anymore because we have speed limits of 30 kilometers in the city. If you push on the accelerator of any car, you're at 15 split seconds. So I have constant tickets and parking tickets. And then you can't do this here and you can't do that there. And then so there's very little freedom in the end.
All right. Well, look, I want to put a pin in that because I want to get more deeply into that. Just a couple quick things to wrap up the economy side. One, your comments here are making me think of conversation I had with Lacey Hunt just a few weeks back. He was giving a presentation at my recent conference and showing how the government multiplier is actually negative, right? And that's essentially what you're saying, not only to economic growth, but to freedom as well. All right, so Marc, just to kind of wrap up the money side of the discussion here, just a couple rapid fire questions for you, because I know that people are going to have a hard time moving on until we scratch this itch for them. As you look into 2024, you mentioned that a lot of the indicators that you're seeing right now, economic indicators, suggest stagnation. Do you see us being able to avoid a recession in the next, relatively near term, year plus or so? Or do you expect the lag effect of the dramatic increase in cost of capital that's gone on, plus the slowing economy, to really start pulling economic growth down into recession?
I think most people are already in recession, but they may not notice it because the salaries are going up, but the salaries are going up less than the cost of living. So to answer your view is, I don't think we can avoid a recession, but what I believe is that for the next 6 months or so, the rate of inflation will not be very high unless we have an escalation of wars in the Middle East and in Ukraine. That is a wild card. But other than that, if we can kind of keep it on a low burning level, these conflicts, then the rate of inflation should come down temporarily. But long term, if you look at the pattern of the 70s, we had 3 waves of inflation. The first wave until 69, then we cooled down until 72, then another wave until 74, and then a cooling down until 76. The final wave was the strongest wave, the third wave, that led to very high rates of inflation. But I think looking at countries like Turkey and Argentina, I wouldn't be surprised in the world if in 10 years' time, our inflation rates would be very high, maybe 30, 40%, maybe higher.
Sorry, are you talking about Turkey and Argentina, or are you talking 30 to 40% inflation amongst the major currencies, like the dollar, the euro?
Yes, I was referring, if Turkey and Argentina can survive with inflation rates of 100% or so, we could have in the Western world inflation rates of 30, 40% quite easily.
Okay. I'm going to talk some of my questions in the future that we're going to talk about, get to the specter of sort of a social uprising, because this populace is getting so injured that they eventually just have no choice. When you start talking about 30 or 40% inflation, I have a hard time seeing that not happening.
Well, I mean, I'd say the government today in the Western world, or the governments, they have three choices. They all have deficits, okay? So they can solve the deficit question as follows. They could cut down spending meaningfully, okay?
Mm-hmm.
So you, my representative and diplomatic chief, you go and explain the veterans of the military and of the police force and of the fire man. You explain to them that in future they'll get 20-30% less pensions.
Right.
So you'll see what kind of social unrest you'll get.
You'll get, yeah, and so now, that's one option, right? Which I think no politician would ever do unless someone was holding a gun to their head.
Well, the socialists, communists, they can do that if the state owns everything.
Mm-hmm.
But the easier way is to go. That's one way. Cut spending meaningfully. It's practically not possible. The other way is to increase taxation meaningfully. It's very difficult because the rich will always find ways not to pay taxes.
They'll find loopholes.
In the whole history of mankind, tax evasion was the favorite pastime. And there's only one tax that is popular in the world's history, is a tax on your neighbor, not on you.
Okay, and that has a limit too, because you can only tax your populace up to some point where they say no way, no more, right? Yeah.
Yes, you can't bankrupt your neighbor, otherwise you get the worst one.
Right.
but
so then the last is what? The currency?
The third way, and the easiest one in every society, has been to print money.
Mm-hmm.
This is the way to come out. And I have a book, this I recommend to your viewers as well. Maybe I've mentioned it before. You see, this man was an Italian, but he was working for the Reichsministerium in the years 1918 to 23. His name is Constantino Bresciano Toroni. He was a famous economist. And the book is The Economics of Inflation.
The economics of inflation. Okay.
Yes. And he analyzes the impact of inflation on stock prices, on the currency, on precious metals, on society, and on wealth inequality and wealth concentration. Everything is described in details. This is the Bible. Everyone needs to read if he wants to understand the causes and the effects of inflation on society. Anyway,
Marc, you're doing a great job.
On society is not very favorable. I can tell you that.
Okay, and look, it sounds like, sadly, you're very confident that this is the pathway of the future of the world's major economies.
When I look at the central banks, what characters are running central banks, yes, this would be my conclusion. When I look at the power that governments have acquired and their unwillingness to cut spending, because you understand the bureaucracy has always been a big problem in the organization of a society. How do you get a department like the police force to reduce its size by 30%? How do you get the firemen to cut down spending by 30%? It's very difficult. And people always, this is something, that's why I brought up this book, Capitalism and Freedom. You can only have freedom if you are prepared to assume responsibility.
Mm-hmm.
If each time it rains, or there is a fire somewhere, or an earthquake somewhere in the world, if each time you say the government should do this, the government should do that, then you ask for the government to become big.
Right. It's the Ben Franklin, those who trade security for freedom deserve neither.
Yes,
No,
yes.
those who trade freedom for security deserve neither. Yeah.
Yes, exactly. Yes, this is the issue of freedom versus security. I mean, if you want to insure everything, you can, in principle, but you will have very little money left if you insure everything. But the point I want to make is young people today, and maybe at the time I grew up, it was similar, but not as extreme as it is today. Today, young people have great aspirations, or they have great expectations, but are not prepared to offer sacrifices.
Mm-hmm.
In other words, you understand, if you want to be wealthy, the number one condition is you have to work hard. Because the world has 8 billion people, and I can assure you, there are lots of people in this world who are willing to work
hard.
50 hours, 60 hours, 80 hours a week. So if someone says, I want to be rich and work 35 hours, forget it. It's not going to work. Now, someone will say, no, it works because I won the lottery. Yes, there are always exceptions, but I'm talking about an entire society becoming affluent. Rome became affluent because they were very disciplined initially. And virtue in Rome was a very important quality in your behavior. I'm not sure they were more virtuous than we are, but it was expected that a citizen would really work for the general good of Rome. He would be a soldier, he would be a statesman, and so forth. So it was a culture that was energy-driven. When the empire failed, it was also because it spent too much money.
Mm-hmm. So this,
and because nobody wanted to pay tax, they printed money.
there's a saying out there, I'm sure most viewers are familiar with it, that you're just hammering on right here, Mark, right? This is the hard times create strong men create good times create weak men create hard times, right? And I agree. I think the younger generations perhaps exhibit what you're talking about. To be honest though, Mark, I would say in the West, I would say almost all living generations don't have the backbone or the diligence or the work ethic that, say, you know, the greatest generation had, right? The generation that fought World War I, you know, World War II, rebuilt the world after World War II. I think we've all sort of lost the hustle, the work ethic, the, you know, communal sense of shared sacrifice to be building something greater for everybody, but still leave the door open for individual achievement. You know, that's my own personal thoughts. I'm curious to hear what yours would be.
My father's generation, my grandfather's generation, and also myself, we were brought up relatively frugally and with hard work. I mean, it wasn't an option for me when I finished my studies to say, oh, I'm not going to work and I take a holiday or, you know, take it easy for a while. No, society expected me to go and get a job, and I wanted to do it because I knew one of the things that disturbed me throughout my school years, from primary school to college and so forth, was the lack of freedom. And why? Because I need the money from my parents. If I wanted to go to the movie, I had to get pocket money from my parents and so forth. I also happened to work, so I had some own money, but not enough freedom. Once I worked, I felt free because I could choose where I live and eat at the time I choose to eat and sleep when I wanted to sleep and so forth and so on. The only thing I had to do is work. But aside from work, I was entirely free. I could choose where to work. So I believe, and this is also my observation, and if you have parents of children or whatnot, I think my observation is that most people are much happier if they are working than if they're not working.
Right. And if they're working, they have a sense of purpose, but also if there's a sense in their work that the harder or more efficiently they work, that has some direct connection to their ability to get ahead, right?
Yes. I mean, I'm a Christian and I pray, not 3 times a day, but once a day. And I'm always grateful that at my age, I still have a job. Okay, it's my job. I don't work for anyone else, but I'm happy to do something and I'm still studying things because the more you study, the more problems come up, and the puzzle of life, when philosophy and history and geography falls slowly into place, but it's never complete because there are always new events occurring.
Right, right. All right. Well, look, Marc, you're taking this again right where I want to go. Real quickly, just to close out the money side, and I hate to be this pedestrian, but as you look at your current outlook for next year, and you are looking, we have a lot of people watching this channel who are looking to position themselves intelligently for what might lie ahead, but I think most of them just don't want to position themselves unintelligently, right? They just don't want to become a casualty of what may happen next year with some of the trends we're talking about. Are there any particular favored assets or unfavored assets right now that you feel particularly strong about? I heard you say earlier that you feel like the emerging markets are beginning to look like they may offer some values here. I'm guessing for your thoughts about what might happen with the currencies and some of the central planner responses. Maybe you're still, maybe the sun is shining a little bit brighter for gold and some hard assets, but I don't want to put words in your mouth. What are you looking at right now?
Yes, I always have a position in precious metals, and my preference is to have physical metal in your pocket here, where you live. And I know that some people favor bitcoins and cryptocurrencies and so forth, but we've now seen with the aggression in the Gaza Strip that you can switch off the electricity and the communication network. So try to buy something in a grocery store with bitcoins and the internet doesn't work. Or book a ticket, whatever. Number two, so that where you hold your assets, I think this is an important issue, whether it's stocks, bonds, commodities, or real estate. Where the asset is physically located is important. And diversification, I'm sorry to say, would involve owning some assets outside of the US imperium, empire. And then there are markets that go up every year, but they're not the same markets. So at the end of 2021, I recommended on a few occasions to buy Turkey. And of course, everybody sent me emails and said Turkey is very bad because they have high inflation and so forth and so on. But the currency had collapsed and assets were very cheap. The Turkish fund went down to something like 17. And then in 2022, the Turkish fund is an ETF doubled in value in US dollars. And then a year ago, what was very cheap were markets in the Middle East, in particular in Iraq. And this year, the Iraq fund of a friend of mine is up by more than 90% in the first 9 months.
Wow. And that's in US dollar terms?
I'm now talking about special situations. I think the market of Pakistan is very depressed at the present time. Now, again, people will say, well, Pakistan is horrible and so forth and so on. But it is bad, but the market is very cheap and stocks are very cheap. So the small investments in the Pakistan fund is probably appropriate. The other region that if you look at the, I have some friends, they're highly educated and intelligent. They think we are headed into World War III. If World War III is a scenario, and I would give it a certain probability, not very high, but a probability in the next 12, 18 months, then I would say the region that is probably the best to invest would be Latin America.
Mm-hmm.
Because the war theater would be somewhere in the East and South China Sea, moving into China from the south and moving into China from the north, in other words, from Alaska. And then another war zone would probably be in the Middle East and Eastern Europe. I'm just guessing. I don't know for sure. But Latin America, to me, would seem to be a bit remote from the war zones.
Yeah, and those are resource providing countries, and they would probably be providing resources to a lot of the players in the theater.
The markets are relatively cheap.
Yep, I know Brazil's done quite well recently.
You know, right? I lived more than 30 years in Hong Kong after 1973. And then in year 2000, I moved to Thailand, but I have an office in Hong Kong and I'm a frequent visitor. I have never, ever seen the mood about Hong Kong and China to be as negative as it is right now. I think we are in Asia, in some markets like Hong Kong and China, close to a major low. Now, can we go down another 10%? Yes, but we can also go up 50% quite easily from here. I looked the other day at Hong Kong Land. It's a major landlord in the central district of Hong Kong, but they also have holdings in Vietnam and so forth and so on. Hong Kong Land sells at 0.22% of net asset value, of book value. Now we can all agree that the property price in Hong Kong will come down by 30%, but not by 80%. So I think a lot of Hong Kong property stocks which sell at a 60, 70% discount to asset value are inexpensive. But you may have to wait, and you may only earn the dividend for the next 2-3 years. But I think in my scenario of governments printing money, I think inflation will come back one day with a vengeance, by the way.
Okay, inflation with a vengeance, and most of the things that you listed here should perform well if that indeed does happen. Couple quick questions on
financial assets in inflationary times, like in the 70s, they don't perform particularly well. But, you know, if we look at precious metals.
That's what I was thinking.
I like precious metals, but I also see that they're not as cheap as they were in 1970. Because in 1970, the price of gold was no higher than in 1935.
Because it had been fixed at $35
yes.
an ounce. Yeah.
And so forth. But also the price of oil was very, very cheap in 1970 because the Western nations who controlled oil, they kept it artificially low.
So, Mark, just a couple quick clarifying questions on this. So for owning assets ex-US, right, out of the US sphere of influence, now for precious metals, that's pretty easy because there are companies that will let you, put money in a Brinks vault in different countries. But for equities, are you saying actually open like a brokerage account in a foreign country?
Yes. Okay. I think that's a good idea.
Okay.
And then also in terms of real estate, I wouldn't own all the real estate in one country. I would diversify a bit.
Absolutely. And for the countries that you mentioned, for finding, actual funds and opportunities to buy in there, are there any resources that you would recommend this audience go check out? And I don't know, perhaps you talk about, specific funds and whatnot in your gloom, boom, doom report, but, are there any Any resources you could direct folks to for that?
Well, I use research that is published by independent sources and also by banks as a source of information. If a bank says buy this or sell that, it doesn't impact my investment decision.
Mm-hmm.
But I just want the information presented by the bank. And usually I would say that the technical analysis is as valuable as the fundamental analysis, because the analysts in general are horrible in their forecasts. In the US, the quality of analysts is higher, but you have in each field maybe 3 leading analysts, and the rest is not particularly good either.
Okay. All right, and I'm going to give you a chance to talk a little bit more about it at the very end. But if folks read your gloom, doom, boom report, do you mention from time to time, hey, this is a fund that's caught my attention?
Yes, of course, yes.
Okay, great. And I'm sorry to be talking so fast. I want to be very respectful of your time, and I'm about to hit you with a big question here, if that's all right, now that we've talked about the money stuff. I was just at a conference, had the real privilege of moderating a panel that I was actually not supposed to moderate. The moderator, a fellow named Gary Alexander of Navalier Associates, was supposed to moderate it, and he ended up not feeling well, so I had to step in at the last minute. Great panelist. Matt Taibbi was on there, a few other great minds. I kicked off the panel with reading some of Gary's prepared notes, and I'd just like to read it to you quickly and get your reaction to it.
Okay.
Here's what he said. He said, "I never thought I would say this, but the last 2 decades, since George Bush and Karl Rove, have made me say that the 20th century looks like responsible government spending and control by comparison to the 21st century so far. The federal deficit has exploded tenfold since 9/11. It looks like Obama bin Laden won on that fateful day. He turned us into paranoid terrorist fighters, overseas warmongers, homeland spies of our own people, and terminal spendthrifts." I'd like to get your reaction to that. And if so, what causes, in your estimation, are principally responsible for this?
Well, that's a good question. What is responsible for developments in societies, which way they go, and so forth? In general, I don't believe that the system of democracy, the way we have it, will work.
Our interview with Marc will continue over in part 2. Before you go watch it, be sure to hit the like button and then click the subscribe button below, as well as that little bell icon right next to it. As you know, this is a new channel, and so we want to rebuild the subscriber number as fast as we can to make sure that the YouTube algorithm knows to share this video widely with other critically thinking viewers like you. Also, by clicking on that little bell icon, you'll be alerted when we release new interviews in the future. And boy, do we have a great lineup of experts already booked for the rest of the year. Just in the next 2 weeks, I'm recording a debate with Matt Peipenberg and Brent Johnson. Yes, that long-awaited matchup is indeed happening. Then with David Rosenberg, then Fred Hickey of the High Tech Strategist, then Ted Oakley, and then Jesse Felder. And that's just warming up for who's to come afterwards. Also, if you aren't yet subscribed to my new Substack account, go to that now at adamtaggart.substack.com. It's completely free to subscribe, and that's where I'll be sharing important updates in the weeks ahead about what's next for Thoughtful Money. Okay, I'll see you next over in part 2 of our interview with Marc Faber, which should be right here. Just click on it to watch the rest of this interview. Thanks so much for watching.